Sinclair Broadcasting is a U.S.-based consolidated media company that operates and creates content for their over 190 TV stations and 630 channels. They currently operate through two segments: local news and marketing services, which accounts for approximately 68% of sales, and sports, which accounts for approximately 32% of sales. They were founded in 1986 by Julian Sinclair Smith and is headquartered in Hunt Valley, Maryland. Through the operation of all their TV stations and channels, the company reaches approximately 40% of U.S. households annually. As a result, top-line revenue is dependent on the political advertising cycle and accounted for a nearly 14% jump in broadcasting revenue from 2015 to 2016. As 2020 is an election year, they're expected to benefit from the increased spending once again, and this should offset the loss of core advertising revenue from the first half of the year. The onset of COVID-19 caused massive dislocations across several industries, with Sinclair's acquisition of 21 RSNs from Disney appearing particularly ill-timed. The transaction increased long-term liabilities by nearly 40% and was viewed as a negative by Wall Street analysts, considering the recent tightening in the credit markets. Additionally, there's a lot of doubt surrounding their broadcasting subscriber base. The cord-cutting trend is continued during the first half of 2020, with an overall subscriber churn rate of 7%. Also, there was uncertainty surrounding the renewal of their distribution agreement with Comcast, which accounts for nearly 17% of RSN subscribers, which expired this year. Moreover, analysts were not only worried about the integration of the RSNs, but the premium price associated with them, as they thought this would lead to distributors potentially dropping the networks. All of these factors weighed on the market's outlook, and the stock fell nearly 60% to $20, or at a 4.96 multiple. I think that even with the added debt, Sinclair is undervalued. Core advertising revenue is highly levered to the economic cycle, and management expects it to likely recover strongly. Additionally, the company's national reach hasn't changed. The doubt surrounding Sinclair's RSN's asking price to distributors is unwarranted, as they maintain pricing power. If distributors attempt to drop one channel, Sinclair has the option to make it an all-or-nothing deal because of the scale of their channel offerings. Worries about their subscriber base decline accelerating should be put to rest, as the Comcast renewal brought total locked-in subscribers to over 80% for at least the next 2 years. Finally, current share prices do not reflect the opportunity presented by next-gen TV. If Sinclair can efficiently grow this segment, they will be able to gain direct access to the customers of the content distributors they once relied on. It's recommended that Sinclair be added to the AIM Small Cap Equity Fund with a price target of $31.19. I'm going to move on to my drivers. The first one is no sports, no problem. The onset of the COVID-19 pandemic dislocated many industries and made Sinclair's acquisition of their 21 RSNs from Disney appear particularly ill-timed. However, their contracts with distributors and the teams require them to compensate one another for the lost content in the MLB, NHL, NFL, and NBA. Although not quantified by management, Sinclair expects to actually receive a net cash inflow somewhere in the range of $70 million in the second half of 2020. With the current lack of entertainment available to customers, the pent-up demand will have a material impact on Sinclair when sports resume full-time. This was evidenced by ratings on the first day of the MLB season on the RSNs being up 32% year over year. Expansive portfolio. The company has overseen more than 11 successful acquisitions and integrations over the past decade, including their recent purchase of Disney RSNs. While they expect to see some operating margin compression as a result, the move positions Sinclair with the largest collection of RSNs in the U.S. Post-acquisition, they will broadcast over 4,600 professional sports games every year, and that doesn't account for the local sports games. Televisionaries. Although not explicitly stated by management, analysis of a few key strategic investments brings to light the company's attempt to pivot away from their reliance on cable TV distributors. In 2019, the company launched Stir, a free, ad-supported streaming app with access to national news, sports, entertainment, and a robust on-demand video library. Sinclair will be able to use Stir as a springboard for entry into the streaming market. Such a move could have an incremental revenue impact of about 4% annually. Moving on to my valuation. In order to reach a fair value estimate for Sinclair, a 5-year DCF model was constructed. Using a terminal growth rate of 1.1% and a WACC of 8.12%, an intrinsic value of $27.82 was reached. A sensitivity analysis of plus and minus 50 basis points on the terminal growth rate and plus minus 100 basis points on the WACC ranged from $26 to $28. Moreover, a relative value analysis was conducted using peer average price to sales and price to earning multiples of 1.73 and 14.1 times respectively. The price to sales valuation resulted in an intrinsic value of $62, and the PE resulted in an intrinsic value of $60. I weighed the models 90-5-5 to reach a price target of $31.19, representing a potential upside of 46%. And on to my risks. My first risk is cannibalization. As Sinclair's subscriber base continues to wane, the company will be forced to pivot and determine a better way to reach their subscribers than through traditional channels. As such, they run the risk of taking away their existing subscribers from the broadcasting segment. My second risk is integration complications. The effects of COVID-19 have led to management's implementation of strict cost controls in the third and fourth quarters of the year. Even with management's extensive M&A experience, limited capital resources raise the question about how smooth the transition will be. And lastly, management. Sinclair is headed up by David D. Smith, who's been president and CEO from September 1990 through the present. Lucy Rudishauser is the acting CFO and executive vice president for the company. She has numerous years of experience in the role at several different companies. Steve Rosenberg recently took over as the new broadcast programming executive. With time spent at Universal Studios, he brings with him years of experience in the space and a fresh set of ideas to improve viewership with the lack of sports content. And on to my closing. I think this is a deep value play. Currently, the market is hyper-focused on the loss of sports and the declining legacy subscriber base. In line with that, the market is completely discounting the growth potential from a pivot. As we take a long-term view, I think this stock is extremely undervalued and has a lot of room to grow. Thank you.